Hi there, I'm Khalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. If you've been following my tech series, you know the drill. And if you're new here, welcome to the club. Today, we're going to break down Adobe stock using the 5 key factors to form an opinion on whether it is undervalued, fair valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. Adobe is a software giant with everything you need to make your digital dreams come true. Whether you're designing, editing, or making your PDF files look too fancy. From Photoshop and Illustrator to Acrobat Reader, Adobe's got it all. Finally, Adobe Creative Cloud is a bundled solution of its products, which evolved into a subscription-based SaaS offering, generating healthy growing revenues for the company. Before we dive into Adobe, don't forget to give the like button a little love, and if you're new here, subscribe to my channel so you never miss out on any future content. Now let's break Adobe down into our 5 key factors. For the first factor, we look for companies with high returns on capital deployed, preferably a return on invested capital and return on equity ratio that is above 15%, as this gives a strong indication of financial efficiency and future profitability. Adobe ticks the box with a return on invested capital of 24.1% and a strong return on equity of 36.3%, with both ratios showing an upward trend over the long term. The spike in 2020 was caused by a one-off tax benefit of $1 billion from intra-entity transfers of certain intellectual property rights. Next to that, we look for companies that are able to grow earnings. Adobe's revenue grew at a compounded annual growth rate of 14% and 15.4% for earnings per share over the past 5 years, reaching $12.4 in earnings per share for fiscal year ending 2024. Earnings per share are estimated to grow with 12% in fiscal year 2025 to $13.9. In my view, Adobe's revenue growth is very impressive, with a 14% compounded annual growth rate. But I would expect to see stronger growth in net income. If we would take out net income of 2019, which was $3 billion, Adobe's net income was basically flat in the last 4 years, whilst revenues have grown from $12.9 to $21.5 billion, showing roughly 67% growth over that period. Earnings per share have risen at a slightly higher rate than net income as Adobe is buying back stock aggressively, which we will touch upon later. The main driver behind limited growth in net income is that Adobe's expenses are growing almost in line with revenue growth. We see that selling and general expenses have grown with a compounded annual growth rate of 11.8% and research and development expenses with 15.3%. This unfortunately shows that Adobe is not able to scale its operations and significantly grow profits at the same time, which is a red flag to me. Now for the third factor, we look at healthy financials. Adobe has a total debt of $6.1 billion and $7.9 billion in cash and short-term investments, which is rock solid, as Adobe can easily pay down its total debt. Adobe's debt has increased though with $2 billion in 2024, whilst cash has stayed flat. I could not find a reason why Adobe increased its debt position in their 10-K filing. Therefore, Adobe might have used this debt combined with their free cash flows to significantly increase their share buybacks. These aggressive share buybacks remind me of my previous analysis of Apple stock. Just like Apple, Adobe is buying back their own shares in an aggressive manner, which is surprising as they have higher returns on capital. This raises the question whether Adobe can deploy this capital in a meaningful way to add value to shareholders. To me, it looks like Adobe is buying back stock due to lack of growth opportunities or management simply not being able to capitalize on these investments to generate growth and profit. Now let's look at Adobe's valuation. Adobe's PE ratio is 35, which is in the lower range based on Adobe's historical valuation, as expectations were high for Adobe in the past due to its growth profile. Now let's compare it to some tech peers for a better understanding. Adobe's PE ratio is higher than Microsoft at 33.5, Meta at 29.8, and Alphabet at 23.8, but slightly lower than Apple at 37.1. But here's where things get interesting. If we compare Adobe's earnings growth to other tech giants, the picture starts to shift. Adobe's earnings per share are growing at a compounded annual growth rate of 15.5%. Now that's impressive, but when you compare it to peers like Apple, Microsoft, Meta, and Alphabet, Adobe's growth rate doesn't seem quite as strong. In fact, Microsoft, Meta, and Alphabet are all seeing higher earnings growth with lower valuations. According to super investor Peter Lynch, if earnings growth is lower than the price to earnings ratio, it's a red flag. Adobe's earnings growth rate is 15.5%, which is way below that 35 price to earnings ratio, and does not justify that valuation, especially if we would leave out 2019 earnings. A strong moat is key for future growth. It helps protect long-term profits and market share from competition. Now let's dive into Adobe's moat. Adobe has built a strong moat mainly through its dominance in the creative software market. Products like Photoshop, Illustrator, Premiere Pro, and Acrobat have become the industry standard. Not just for professionals, but for hobbyists too. Over the years, Adobe has created a high barrier to entry for competitors. The company has a large, loyal customer base and switching costs are high. Once users get accustomed to Adobe's suite of tools, it's tough for them to migrate to a competitor because of the deep learning curve and time investment required to switch. Additionally, Adobe's subscription model has been a game changer. By transitioning from one-time software purchases to a subscription-based service, Adobe not only locked in recurring revenue, but also built an ecosystem that encourages users to stay. The subscription model also makes Adobe's products more accessible, giving it a constant stream of updates, improvements, and innovations, all of which help keep customers engaged. But it's not all sunshine and rainbows. Adobe does face a few risks. For one, there's the competition risk. While Adobe has a stronghold in the creative space, other companies like Corel, Affinity, and even Canva are nibbling away at market share, particularly in areas like graphic design and video editing, with lower cost or even free alternatives. Then there's the innovation risk. In the tech world, being complacent can be dangerous. Adobe has to keep up with all the rapid changes in technology, especially in areas like AI and cloud computing, or risk losing relevance. Competitors who can develop more cutting-edge or user-friendly features could quickly catch up. Adobe has been pushing an AI narrative for 2 years now, and we still see little evidence of monetization. Based on their earnings, it looks like Adobe is facing pricing pressures and has difficulty with keeping costs down as they are scaling their operations. Now, before we conclude on Adobe, you may have spotted in the charts shown in my video that these were created with the help of FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. To wrap up, in my view, Adobe is overvalued based on the 5 key factors. Adobe has high returns on capital, but they prefer to aggressively buy back stock instead of reinvesting in the business to fuel future profits. At first glance, Adobe's numbers look pretty solid. Revenue grew with a compounded annual growth rate of 14% and earnings per share with 15.4% over the past 5 years. But here's the catch. If you remove 2019 earnings, Adobe's earnings have pretty much been flat over the last 4 years. It seems like Adobe is having trouble scaling its operations while also keeping their costs under control. Adobe has a healthy financial position with $6.1 billion in total debt and $7.9 billion in cash and short-term investments. However, this should be monitored as it looks like Adobe is taking on more debt for stock buybacks. With a price to earnings ratio of 35 and a compounded annual growth rate of 15.4% for earnings per share, The stock isn't exactly a bargain. The valuation is even less attractive if we leave out 2019 earnings. Adobe has built a strong moat mainly through its dominance in the creative software market and their move to a subscription-based model. However, Adobe needs to continue innovating as competitors are nibbling market share with lower pricing. Let me know in the comments what you think, or maybe you want me to dive into another company. Thank you for watching, and see you next time.